Welcome to the Deep Dive. This is the show where we really try to cut through all the noise, and give you the insights you need to be genuinely well informed. Today, we're tackling a topic that's, well, it's not just gaining traction, it's becoming pretty indispensable in the digital economy. I'm talking about stablecoins.
Yeah.
So if you've been curious about how to leverage digital assets for maybe financial growth, security, but you feel a bit lost in the jargon or maybe just overwhelmed by, all the info out there, you are definitely in the right place. We're here to give you that shortcut to real clarity, real confidence.
Yeah, that's exactly the plan.
Okay.
Think of stablecoins as this really clever digital bridge. It connects the, let's face it, often volatile crypto world with the more predictable world of traditional finance.
Right.
So unlike Bitcoin or Ethereum, famous for their big price swings,
Right.
stablecoins are like engineered for stability.
Yeah.
They usually do this by being pegged, linked directly to a stable asset. Most often it's the US dollar, but you see euro-pegged ones too. And this design, it makes them incredibly useful, almost like digital cash, really. Good for transactions, sending money internationally, or just holding value without that, roller coaster ride.
Absolutely. And our mission today is all about unlocking that potential for you. We're going to navigate the stablecoin landscape together, help you spot the really robust options, the ones with longevity, low risk. Then we'll dive deep into practical ways, actionable strategies for generating passive income with them, basically putting your digital dollars to work.
While you sleep, ideally.
Exactly. And beyond that, we'll break down the cheapest, fastest ways to move these stablecoins around. We're talking layer 2 solutions, cross-chain bridges, really cutting-edge stuff. And finally, we'll guide you through choosing the best hardware wallet, to keep your assets safe, but also making sure you can easily connect to DeFi protocols. Decentralized finance.
Get ready for some aha moments, hopefully.
Yeah, because by the end of this deep dive, you should have a really clear roadmap. You'll be ready to participate confidently in this whole digital economy thing.
Okay, so let's really unpack this. Stablecoin. The name kind of gives it away, right? Stability. But what exactly are they? Beyond just being like a digital dollar.
Yeah.
How do they actually do that, maintain the stability?
Right. So at their core, they're digital currencies specifically engineered, designed to keep a consistent value. And the main way they do this is by pegging them to traditional fiat currencies. Overwhelmingly, it's the US dollar, though, things like EURC pegged to the euro are growing.
Okay, the peg.
Yeah.
But how does the peg work? What's backing it?
That's the crucial part, the mechanism. The issuers, the companies behind them, hold reserves, traditional assets. Think cash, short-term government bonds, other really liquid stuff, cash equivalents. And these reserves are meant to fully back every single stablecoin out there, usually 1-to-1. So for every digital dollar stablecoin, there's supposed to be a real dollar or something equivalent sitting in a reserve account somewhere. Gotcha. So it's collateralized. That's the key difference from something like Bitcoin.
Exactly. That collateralization is critical. It separates them from those highly volatile cryptos that don't have that kind of backing.
And that stability, that backing, gives them this really unique utility, doesn't it? Stuff that, Bitcoin just isn't great for day to day.
Oh, absolutely. The utility's huge. Transformative even.
Yeah.
Because they hold their price. Stablecoins have this money-like quality. Other crypto just doesn't have that. So they're ideal for everyday shopping, commercial transactions.
Yeah.
Like digital cash that doesn't, change price while you're at the checkout.
Right.
And they're super efficient for international payments.
Yeah.
Imagine sending money across borders, takes minutes, costs pennies, no banks in the middle, no crazy exchange rate swings.
Yeah, that's a big deal.
Definitely. And of course, they're a secure way to just store digital value without the drama of speculative assets. Some experts call it no questions asked acceptance. Much more practical for real-world stuff than Bitcoin, which, let's be honest, is still mostly seen as a speculative investment.
And it's not just a niche thing anymore, right? Big players are getting involved.
Not at all. We're seeing major financial institutions, huge fintech companies, think Bank of America, Stripe, PayPal, they're jumping in aggressively, investing. They see this isn't just a trend, it's strategic. It's going to reshape cross-border payments. It's seen as that crucial first step, bridging traditional finance and the crypto world.
Wow, that's a massive endorsement. Seeing those traditional giants embrace stablecoins. But okay, like any financial innovation, especially in crypto, which is still pretty new, there have got to be risks. So for our listeners who are thinking, okay, this sounds interesting, maybe I want to use these, what are the really critical risks they absolutely need to be aware of?
Super important question. Because stable is in the name, but it absolutely positively does not mean risk-free.
Right.
Understanding these risks is key to making smart choices. One big one is what's called a run risk, just like a classic bank run. Stablecoins can face panic if people lose confidence. Maybe there are rumors, worries about the reserves. If everyone tries to cash out at once, the issuers might struggle to meet demand quickly, especially if their reserve assets aren't perfectly liquid or if it takes time to sell them for cash.
And that could cause the stablecoin's price to drop below a dollar.
Exactly. That's called a depegging event, where it temporarily trades below its $1 target. You'd want to watch for signs like redemption requests taking longer than usual, or maybe the issuer making sudden announcements about changing their reserve mix. Those could be early warnings. We also sometimes see potential for price instability if the market structure gets weird. Like if only a few big players are doing the arbitrage, buying and selling to keep the price at $1.
The market makers, basically.
Right. If those few can't keep the peg, maybe because the market's crazy or they run out of capital, you can get these temporary depegs. Usually short-lived, but still unsettling and could cause small losses.
We've also heard some concerning stuff about stablecoins being used for, let's say, less than legal activities. How big a risk is that for the average user or the ecosystem?
Unfortunately, that's a real concern. There's data from blockchain analysis firms, like Chainalysis, and it shows a worrying trend. Stablecoins are becoming more popular for illicit stuff. They estimate around 63% of all illicit crypto transactions involve stablecoins.
Wow, 63%. That's huge. What kind of activities?
Serious things: money laundering, sanctions evasion, even terrorist financing. There were reports, for instance, about Russian smugglers maybe using Tether for weapon parts. And after the Hamas attacks in October 2023, there were initial reports suggesting Tether was used for financing. Now, later analysis kind of downplayed the scale compared to traditional methods.
Okay.
But these incidents highlight the potential for misuse. It really underscores why we need strong compliance. Robust anti-money laundering, AML protocols, clear you, your customer, KYC rules. It's critical for the ecosystem's health.
Okay, so beyond bad actors using them, the technology itself, especially in DeFi where these are used a lot, introduces technical risks too, right? What should listeners know there?
Yeah, technical vulnerabilities are a serious and, frankly, complex issue, especially because stablecoins are so deeply integrated into DeFi, decentralized finance. One big category: smart contract exploits.
Okay.
DeFi protocols are basically just code, smart contracts running on a blockchain. If that code has flaws, bugs, vulnerabilities, hackers can exploit them, drain funds. We saw this with the Euler finance hack. Huge. A vulnerability led to something like $197 million in stablecoins being lost.
Ouch. $197 million.
Yeah. Then you have things like flash loan attacks. These are incredibly sophisticated. An attacker takes out a massive loan with no collateral, a flash loan, but it has to be repaid in the same transaction block.
How does that even work?
They use a huge amount of temporary cash to manipulate prices on different DeFi platforms, maybe destabilize the stablecoin's peg, make a profit from the chaos, and then repay the loan, all in seconds.
Wow, that's complex.
It is. It's like borrowing $1 billion for 5 seconds, messing with the market and giving it back before anyone notices.
And what about those really catastrophic failures, like Terra USD? That really shook people's confidence, didn't it?
Oh, absolutely. That was a massive wake-up call. The Terra USD, or USD collapse in 2022, a stark warning. UST was an algorithmic stablecoin, meaning it wasn't backed by cash or bonds in a vault somewhere.
Right, no traditional collateral.
Exactly. It used complex algorithms and this arbitrage thing with a sister token, LUNE, to try and maintain its $1 peg. The idea was, if UST dropped below $1, traders could burn UST to mint LUNE at a profit, pushing UST back up. If it went above $1, they'd burn LUNE to mint UST.
Sounds clever in theory.
In theory. But when UST faced a massive sell-off, confidence just evaporated. The whole system went into what they call a death spiral. UST's price crashed. That caused a flood of new LUNE to be minted, making LUNE worthless. The arbitrage mechanism broke down completely. Tens of billions of dollars in value just vanished. It really showed the fragility of purely algorithmic designs and, frankly, the critical need for robust, transparent, actual collateral backing.
So even for the stablecoins that are backed by fiat, like dollars, there can still be big differences in risk depending on how transparent they are. It's not just saying you have reserves, it's proving it.
Precisely. That brings us to centralized issuance risks. Take Tether, USDT. It's huge. consistently the world's biggest stablecoin by market cap.
Huh.
But it's faced these long-standing concerns about its reserves. How transparent are they? Are they really 1.1? Are they fully liquid? Are they independently verified?
Yeah, I've heard those questions for years.
Right. Tether has never, ever undergone a full, comprehensive independent audit by like a Big Four accounting firm. They opt for these quarterly attestations.
What's the difference? Attestation versus audit.
An attestation is basically an accounting firm looking at what management claims about the reserves at a specific point in time. It's much less rigorous than a full audit, which involves deeper digging, verifying financial statements, testing controls. It's a much higher level of assurance. So this lack of a full audit with Tether raises legitimate questions. It could be a source of that run risk if confidence falters or regulators crack down. This is a sharp contrast to other issuers who are actively pursuing more frequent, more rigorous audits and providing much more detail about what's actually in their reserves. That offers a higher degree of confidence.
Okay, so understanding those risks is absolutely crucial. Now, how do we identify the stablecoins that are, most likely to stick around, lowest risk of failure, and especially focusing on the ones with the biggest market caps? What does the current landscape look like? Who are the main players?
Right, connecting this to the bigger picture. The global stablecoin market is massive. We're talking around $255 billion as of, say, mid-2025. And what's really telling, almost fascinating, is that dollar-pegged stablecoins, they make up something like 99% of that entire market.
99%. Wow. So much for decoupling from the dollar.
Exactly. It really underlines the dollar's enduring global power, even in this new digital form. Now, there are hundreds of stablecoins out there pegged to different currencies, experimental designs, but the market, it's overwhelmingly concentrated. Just a couple of key players really dominate.
Okay, let's zero in on that. Our listener wants the top 4 best for longevity, low risk, high market cap. Based on our sources, who are these dominant players that kind of fit that bill?
Well, the top 2, by far, in terms of market cap, volume, widespread use, are Tether, USDT, and USD Coin, USDC. Tether, as we just discussed, is the biggest. Market cap over $169 billion right now. It's been around since 2014, so it has history. It's known for massive trading volume, especially popular in emerging markets where maybe traditional banking is harder to access.
But with those lingering transparency questions we mentioned.
Exactly. That's the caveat. Its longevity and risk profile are constantly questioned because of those reserve transparency concerns. No full independent audit. So yes, it's high volume, very liquid, but there's that asterisk next to its long-term low-risk profile compared to some others.
Okay, so what about number 2? USD Coin, USDC. How does that compare, especially with its focus on compliance?
Right, USDC. It's issued by a company called Circle, and they've been making some very significant, very strategic moves, clearly positioning themselves as the compliant, transparent option. For example, Circle's setting up a new global headquarters right in One World Trade Center in early 2025. That's not just symbolic. It signals a deep commitment to operating within the established U.S. financial system, playing by the rules.
And their reserves, are they more transparent than Tether's?
Generally, yes. USDC provides regular attestations, but often with much more detail and clarity on what's actually backing the coin. They tend to use reputable auditing firms. The goal is definitely to provide a higher level of assurance about that 1.1 backing. So while USDT has the sheer size and history, USDC is deliberately carving out that compliant stablecoin niche. And for many users and institutions, that translates directly into lower perceived risk and higher confidence in its longevity.
Okay, so USDT and USDC are the 2 big centralized fiat-backed ones. Is there a prominent decentralized option that people use alongside them, even if the market cap isn't quite as huge?
Yes, absolutely. While it doesn't crack the top 2 or maybe even top 4 strictly by market cap alone, DAI is consistently mentioned. It's a key player, especially in DeFi protocols like Aave and Uniswap. You often see it paired with USDC, for instance, in liquidity pools, like USDC DAI pair.
And what makes DAI different? Why do people choose it? The key difference is decentralization. DAI offers a genuinely decentralized alternative to the centralized models of USDT and USDC. It's issued by MakerDAO, which is a decentralized autonomous organization, a DAO. And it's collateralized, but not just by dollars in a bank. It's backed by a diverse basket of other cryptocurrencies held in smart contracts. This really appeals to users who prioritize censorship resistance. They want to minimize reliance on any single company or point of failure. So if you look at market dominance, USDT, USDC, plus widespread DeFi use and a distinct model, DAI, those 3 really emerge as the most prominent names from our sources when people talk about key stablecoins. Finding a clear fourth that fits all criteria equally is a bit trickier based on just market cap and consistent mention across all areas.
Got it. USDT, USDC, DAI. That makes sense. Now, this brings us to something absolutely critical. Regulation. How is this rapidly changing regulatory landscape shaping the future, affecting longevity, building trust, or maybe sometimes eroding it?
Regulation is. Honestly, it's the crucial factor for long-term stability and trust in this market. No exaggeration. And right now, we're seeing these fundamentally different approaches from the major global powers, particularly the US and the EU. It's really shaping up to be a new kind of currency war in the digital space.
Okay, currency war, interesting. Let's start with the US. What's their approach?
The U.S. approach seems distinctly pro-stablecoin, at least privately issued stablecoins within a regulated framework. In June 2025, the U.S. Senate passed the GENIUS Act. That stands for Guiding and Establishing National Innovation for U.S. Stablecoins. Landmark legislation, really.
The Genius Act sounds potentially like a game changer. What does it actually do? What does it require from issuers? What are the big goals?
So the GENIUS Act aims to create a clear, strong regulatory framework specifically for stablecoin issuance, mainly by banks and other regulated financial institutions. It's about integrating stablecoins directly into the existing U.S. financial system. The requirements are pretty strict. Issuers have to hold 1.1 reserves, $1 in the reserve for every stablecoin out there.
Okay, 1-to-1. That's key.
Absolutely. They also have to publish regular, verified audits, follow clear rules to protect users, ensure market integrity, and critically, those reserves. They have to be kept separate from the company's other assets. No commingling, prevents misuse, and they need to be verified monthly. That gives ongoing assurance.
And the bigger strategy behind this, why is the U.S. taking this pro-stablecoin approach?
Well, it definitely reflects a pro-growth, pro-innovation, maybe even pro-crypto stance from the administration at the time. The goals are ambitious. One stated aim is to make digital dollars the reserve currency of the internet, basically strengthening the U.S. dollar's global dominance in the digital age.
Interesting goal.
Yeah, and proponents also argue it could create a sort of captive market for U.S. debt, because stablecoin issuers might be required or incentivized to hold a chunk of their reserves in U.S. government bonds. Some even suggest this could help reduce the national debt by 2030, though that's a pretty bold economic projection. Depends on adoption, market conditions.
Sure, lots of variables there.
Right, and it also aims to empower big U.S. companies, think Walmart, Amazon, who are reportedly exploring their own stablecoins to cut payment costs and maybe create new revenue streams with digital currency services. And it works alongside another act, the Stable Act, which sets broader rules for the whole crypto market. It's meant to be a comprehensive package.
Okay, so a clear push for private stablecoins, but within a strong regulatory box in the U.S. What about the EU? Are they on the same page, or is their approach different?
No, the EU's approach is quite distinct. It leans more towards being pro-CBDC, that's central bank digital currency, even while they are setting up a stablecoin framework.
Okay, explain that. Pro-CBDC, but regulating stablecoins.
So they have MiCA, Markets and Crypto Assets Regulation. It became fully effective mid-2024. MiCA is huge. It's a harmonized, comprehensive framework for pretty much all crypto assets, including stablecoins, across all 27 EU member states. Big focus on investor protection, fair markets, innovation, but within clear guardrails.
And what does MiCA demand from stablecoin issuers in the EU?
Very clear, strict rules. Full reserves are required. Mandated transparency. Issuers need authorization from financial regulators before they can operate. And importantly, under MiCA, only regulated financial institutions like banks or companies that get specific licenses can issue or support stablecoins in the EU now. And what's really significant here is Circle, the USDC issuer. They were the first major stablecoin company to become fully MiCA compliant back in 2024.
So that compliance gives USDC a big advantage in the EU market.
Exactly. It means USDC and also EURC, Circle's Europeg coin, can be passported, basically legally offered and used across the entire EU market. Huge deal.
So the EU is regulating stablecoins with MiCA, but you said they're pro-CBDC. How does that philosophical difference play out? What's the tension between the US and EU approaches?
Right. While MiCA provides the framework, the EU sees it partly as a strategic tool, yes, for consumer protection, but also to potentially raise barriers for non-EU stablecoins, and critically, to promote their own project, the digital euro. The European Central Bank has been pretty clear they prioritize the CBDC for maintaining financial stability, monetary sovereignty, and managing the risks they see from private digital currencies. So it contrasts sharply with the U.S. focus on fostering private stablecoins, that's the currency war dynamic, two major economic powers pursuing different digital currency strategies, each aiming to cement their influence. It has massive implications for the market, for issuers, for the whole global financial system, really. And it's not just the U.S. and EU. Other places, UK, parts of Asia like Hong Kong, Singapore, South Korea, Australia, Japan, they're all moving towards stablecoin regs too. Hong Kong already has its own rules in place. So it's a global trend towards clarity, but definitely not uniformity.
Wow, okay. So for our listeners trying to pick a stablecoin based on longevity and low risk, what's the bottom line takeaway from this complex regulatory picture? What should they really prioritize?
Yeah, this is the absolutely critical point guiding your choice. The implication is clear. Stablecoins operating under strong, transparent regulatory frameworks, like USDC, especially now being MiCA compliant and positioned well for the U.S. Genius Act. They offer significantly higher assurances of longevity and lower inherent risk.
Because of the oversight and rules.
Exactly. Mandated transparency, clear reserve rules, regular audits, government oversight. It all adds up to greater stability and trust. This stands in contrast to stablecoins like Tether, which, despite its size, still faces those ongoing transparency questions due to its less rigorous attestation approach. So if you are prioritizing stability, security, long-term viability, regulatory compliance and verifiable backing have to be top factors in your decision. They should heavily influence which stablecoin you choose.
Okay, now we understand the top coins, the risks, the vital role of regulation. Let's talk about actually using them. Specifically, how do we move these things around efficiently, affordably? Because, as many of us know firsthand, using the main Ethereum network, well, it can get really expensive. Prohibitively so for small or frequent transfers.
You've nailed a core problem. It's a real barrier to wider adoption for just, everyday stuff. Ethereum mainnet, layer 1, it's super secure, super decentralized, yes, but notoriously high gas fees. Network congestion.
Yeah.
Trying to send, say, $50 of USDC, the transaction fee alone might be $20, $30, sometimes even more during peak times. It just doesn't make sense.
Right, so what's the fix? How do we get around those crazy fees and delays but still benefit from Ethereum security?
The solution, and it's really elegant, is layer 2 blockchains. L2s, these are absolutely essential for scalability. Think of L2s like express lanes built on top of the main Ethereum highway.
Okay, express lanes, I like that.
They work by processing transactions off the main Ethereum chain. This slashes costs and speeds things up dramatically, often by orders of magnitude. But here's the clever part. They still inherit the security of Ethereum mainnet. They use tech like rollups.
Rollups. Heard that term. What does it mean simply?
Okay, simple analogy. Instead of every single car, every transaction, paying a huge toll on the main highway, lots of cars get bundled together onto a special bus. That's the rollup. This bus takes them onto a side road, the L2, where they all do their thing much faster and cheaper. Then the bus comes back to the main highway and reports a single, verified, compressed summary of everything that happened on the side road. So all transactions are secured by Ethereum, but without clogging up the main network.
Okay, that makes sense. Bundling transactions off-chain, but settling the summary on-chain.
Exactly. And prominent L2s like Base, Arbitrum, Optimism,
Yeah.
they're leading the way here. Base, for instance, which is built using Optimism's technology, is particularly interesting. It offers near-instant finality, really low fees for stablecoin transfers. Makes it a great accessible option for users.
Fantastic analogy, thanks. So L2s solve high fees on one network. But what if my USDC is on, say, Arbitrum, and I need it over on Base? Or maybe back on Ethereum mainnet for some reason? How do I get it across reliably, affordably? That's where bridges come in, right?
Precisely. Cross-chain bridges are your essential gateway for moving stablecoins between these different networks. These are sophisticated protocols designed to let you send or swap stablecoins, USDC, USDT, DAI between various blockchains, L2 to L2, L2 to mainnet, even between completely different ecosystems sometimes. The modern bridges. They're incredibly efficient now. Transfers can happen in minutes. Fees are typically pretty low, maybe 0.05% to 0.3% of the amount, plus the network gas costs. And what's interesting is the best bridge really depends on what you prioritize. Is it the absolute rock bottom cost, lightning speed, or ironclad security?
Okay, can you give us a sort of breakdown, a graded look at some popular bridge options for stablecoins, help listeners figure out which might fit their needs?
Sure, let's look at a few leading ones. First, Synapse Protocol, often seen as the speed and cost leader. Advantages. Synapse consistently offers some of the lowest fees out there, like studies show up to 80% savings on some routes compared to others. Transfers are super fast, near instant. Bridge fees themselves are minimal, often near zero for stables. And a key point, It moves genuine assets, not wrapped versions, which can simplify things. They even have fee reimbursement programs on some networks. Best for you if you're really watching costs, transfer stablecoins frequently, and need speed for moderate amounts.
Okay, Synapse for cost and speed. What else?
Next up, Stargate Finance, known for being reliable and fast. Advantages. Stargate uses Layer Zero's tech, which is known for secure omni-chain communication. You get fast transfers with instant finality. Their fee is a simple flat 0.06%, supports 15-plus major chains, including the popular L2s, and a really neat feature, destination gas token support.
What does that mean, destination gas?
It means you can often pay the gas fee for the transaction on the destination network using the stablecoin you're receiving. So you don't need to already have, say, base ETH in your wallet on base before you bridge USDC there. Super convenient. Best for you. You value a good balance of speed, reliability, ease of use, maybe aren't chasing the absolute lowest fee, and need broad chain support.
Got it. Convenience factor there. What about top security, if I'm moving a larger amount?
Then you look at Wormhole Portal. Maximum security focus. Advantages. If security is your #1 priority, especially for big transfers, Wormhole stands out. It got Uniswap's Bridge Assessment Committee's stamp of approval for unconditional security. It's a big deal. Supports 30-plus blockchains. Huge track record, processed over 1 billion messages. Extensive audit history. Think of it like a digital armored truck. Best for you if you're moving significant sums and security is absolutely paramount, even if it costs a bit more or takes slightly longer sometimes.
Armored truck. Good visual. Any others worth mentioning quickly?
Yeah, a few others. Allbridge Core is interesting because it focuses specifically on transfers between EVM chains like Ethereum, Base, Arbitrum, and non-EVM chains like Solana. EcoRose is newer, focuses on finding competitive rates via smart routing. And Chainlink CCTP cross-chain transfer protocol uses Chainlink's trusted Oracle network. It works by burning the stablecoin on the source chain and minting an equivalent one on the destination. Another very secure option. Most of these support the major stables like USDC, USDT, DAI. So your choice is often more about the bridge's features, speed, cost, security, chain supported, than the specific stablecoin itself.
That's incredibly helpful. Okay, let's make it super practical. Let's say I, or our listener, wants to move USDC from Coinbase, a big centralized exchange, to my hardware wallet, and I want to use a cheap L2 like Base to do it. Walk me through the steps.
Yeah, absolutely. This is a really common and highly recommended scenario. Get your coins off the exchange into your own custody using low-cost L2s. Here's how you typically do it. 1. Get USDC. First step, obviously, buy or have USDC on Coinbase. Pretty straightforward. Link your bank, buy the coins. 2. Start the withdrawal. Go to your Coinbase USDC wallet, hit send or withdraw. 3. Select the network critical step. This is key for saving money. When Coinbase asks which network you want to send the USDC on, you specifically choose Base. Coinbase has integrated Base directly, so it should be an option right there in the list. Choosing Base means low fees, fast transfer. Don't choose Ethereum, ERC20 unless you have a specific reason and are okay with high fees. 4. Enter your wallet address. Finally, you paste in your hardware wallet's receiving address. And this is super important. Make sure it's your wallet's address on the Base network. Your ledger or tangent can hold assets on multiple chains. You need the Base address for this transfer. Double, triple check it.
Okay, so acquire USDC, withdraw, choose Base network, enter the correct Base address for my hardware wallet. Seems doable.
Exactly. It lets you move your stablecoins efficiently, affordably, off the exchange, where you have counterparty risk, and into your own secure hardware wallet, ready for DeFi or just safekeeping, leveraging L2 benefits.
Perfect. Now, speaking of security, blockchain transactions are final, irreversible. What are the absolute must-do best practices people need to follow every single time they make these transfers? Bridges, L2s, whatever.
Cannot stress this enough. These aren't suggestions. They're essential habits because mistakes are permanent. 1. Verify everything. Twice. Seriously. Always double-check you're on the official Bridge website, using the official L2 deposit address, interacting with the right smart contract. Phishing sites, scam addresses. They look identical sometimes. Bookmark official sites. Never click random links from emails or DMs. 2. Check network status. Before you send, take 10 seconds. Check the status of both the network you're sending from and the one you're sending to. Are they running normally? Avoid transfers during network upgrades or if there's major congestion or reported issues. It can cause delays or even failures. 3. Do a small test send. First time using a new bridge, new network, new wallet address. Send a tiny amount first, like $5 worth. Verify it arrives safely before you send the main amount. Takes an extra minute, saves potential heartache. 4. Review all details before confirming. Painstakingly check that recipient address again, character by character. Check the amount, check the estimated fees. One wrong character in the address. Funds gone forever. 5. Use appropriate gas. Even on L2s, there's still gas.
Most wallets suggest a decent price. Don't set it too low to save a fraction of a penny, or your transaction might get stuck or fail. 6. Keep good records. Save transaction IDs, TX IDs. Note down timestamps, amounts, tracking if you need support, and absolutely essential for tax reporting. Regulators are watching crypto more closely now.
Right. Verify, check status, test send, review details, gas settings, keep records. Got it. Critical safety checklists.
Absolutely follow those, and you significantly reduce your risk. Helps ensure your transfers are smooth and secure.
Okay, now for the part a lot of listeners probably find the most exciting. We got our stable coins, we know how to move them cheaply, they're secured in our hardware wallet. How do we actually put them to work? Because they're not just for sitting there or making payments, right? They're kind of the fuel, the active programmable money powering this whole DeFi thing, decentralized finance.
That's exactly right. Stablecoins are far more than passive assets. They are the dynamic engine of DeFi. If you connect it to the bigger picture, they act as this crucial safe haven when the broader crypto market goes wild.
Right, like when Bitcoin tanks.
Exactly. Bitcoin or ETH drops 20%. Traders can quickly swap into USDC or DAI without having to cash out to fiat money. They can just park their value in a stable asset within the crypto ecosystem. So, stablecoins become that stable medium of exchange, a reliable unit of account, a consistent store of value inside DeFi apps. They bridge that gap between crazy volatility and the predictability you need for financial operations. They provide the essential liquidity and stability for DeFi to even function.
Okay, so for our listeners who've got their stablecoins ready, how can they actually earn passive income? Let's dive into some of the main strategies in DeFi.
Sure. One of the most fundamental, popular, and generally considered lower-risk strategies is using lending protocols. Platforms like Aave or Compound are the big names here. How it works is, you, the lender, supply your stablecoins, maybe USDC, maybe DAI, into a liquidity pool on the platform. Then other users, borrowers, take out loans from that pool. Maybe they want to leverage up. Maybe they need short-term funds. And you, as the supplier, earn passive interest. That interest comes from the fees the borrowers pay on their loans. It's essentially a peer-to-peer lending market, but managed by smart contracts.
Okay, it sounds kind of like a high-yield savings account, but digital and peer-to-peer. What stops borrowers from just running off with the money? How's the risk managed for lenders? And how would I actually do this with my hardware wallet?
Good questions. The high yields are definitely attractive compared to traditional banks, yeah. But the risk mitigation is key. Loans on these platforms are almost always over-collateralized.
Over-collateralized, meaning
borrowers have to deposit more value in collateral than the amount they actually borrow. So to borrow $100 worth of USDC, they might need to lock up $150 worth of Ethereum or some other crypto asset. This protects you, the lender. There's always more collateral value backing the loan than the loan itself. If the collateral's value drops too much, like if ETH price crashes, the protocol automatically sells off the borrower's collateral to pay back your loan. It's called liquidation.
Ah, okay. Automatic liquidation protects the lenders. Makes sense. So how do I connect my hardware wallet and actually lend?
Right. Your action step would be connect your hardware wallet, your Ledger or Tangem, to a platform like Aave. You usually do this using Wallet Connect. Wallet Connect is this secure bridge, often uses a QR code you scan with your Wallets app. It lets the DeFi site request actions, but your private keys stay safe on your hardware device. You approve everything there. Once connected, you go to the stablecoin section on Aave, find USDC or DAI, and hit supply or deposit. Enter the amount, confirm on your hardware wallet. And that's it. Your stablecoins start earning interest right away, usually paid out in the same stablecoin. And a cool feature, that's supplied amount. It acts as collateral itself, so you could potentially borrow other assets against it if you wanted to get more advanced. But always watch those liquidation levels carefully if you borrow.
Okay, supply stables, earn interest. Seems straightforward. But what are the risks here, even with over-collateralization?
Still risks, absolutely. Smart contract risk, we talked about this. Bugs in the Aave or Compound code itself could be exploited. You're trusting their code. Oracle risk. These platforms need real-time price feeds for all the assets, the collateral, the borrowed assets. They rely on oracles for this data. If an oracle gets manipulated or reports a wrong price, it could cause bad liquidations or other problems. DPEG risk. The risk that the stablecoin you supplied, like USDC, loses its $1 peg. If USDC drops to 90 cents, your earnings might not cover that loss in principal value.
Got it. Smart contract, Oracle, DPEG. Okay, what's another core way to earn, especially for providing liquidity?
Another really powerful strategy, and super common in DeFi, is liquidity provision, LPing, on decentralized exchanges. Think Uniswap, Curve Finance. Here, instead of lending, you deposit a pair of assets into a liquidity pool. For stablecoins, a common pair would be something like USDC and DAI. Other users then use this pool to swap between those two stablecoins. They pay a small trading fee for the swap. And you, as the liquidity provider, you earn a share of those trading fees, proportional to how much liquidity you provided. You're essentially being a market maker.
Okay, providing pairs, earning fees. I've heard about concentrated liquidity on Uniswap v3. How does that work, and why is it supposedly so good for stablecoin pairs?
Yeah, concentrated liquidity on Uniswap v3 was a game changer, especially for stablecoins. See, in older DAX models, when you provided liquidity, your money was spread out across all possible prices, from 0 to infinity, basically. Most of it wasn't actually being used in trades at any given moment. Concentrated liquidity lets you choose a specific price range to provide your liquidity in. For stablecoins, which should trade very close to $1, say, between 60.999 and 1.001, this is incredibly powerful. You can put all your capital right where almost all the trading actually happens.
Ah, so your capital is much more efficient, earns more fees.
Exactly. Your capital efficiency goes way up, meaning you can earn significantly more fees from the same amount of capital compared to spreading it out. And the huge advantage for stablecoin pairs, it makes you largely immune to something called impermanent loss.
Impermanent loss sounds bad. What is it?
It's the main risk when you LP volatile pairs, like ETH/USDC. If the price of ETH goes way up or down after you deposit, the value of your holdings in the pool can end up being less than if you just held the ETH and USDC separately. It's complex, but it's a real drag on profits sometimes. But with two stablecoins, both pegged to $1, their relative price barely changes. So impermanent loss is minimal, often negligible. It removes a major headache.
Okay, so LPing stablecoin pairs with concentrated liquidity sounds pretty good. Lower risk than volatile pairs, potential for good fees. How do I do it?
Your action. Find a stablecoin pair you like, USDC DAI, it's common, on Uniswap v3. Go to Pool, then add liquidity. Choose the two coins, enter the amounts, and then crucially set your price range. For stables, you'd set a very tight range around $1. Confirm on your hardware wallet. The risks here. Still smart contract risk, Uniswap's code. Still depeg risk, if either USDC or DAI breaks its peg. And maybe some minor slippage risk, though it's usually low for stable pairs.
Okay, lending and LPing. What if I want something more automated? Something that finds the best yields for me across different platforms without me having to constantly monitor and move funds.
That's exactly where yield aggregators come in. Platforms like Yearn Finance, Beefy Finance are the big ones. They offer vaults. You deposit your stablecoins into a specific vault, then the aggregator's smart contracts automatically go to work. They manage and compound your yield across multiple underlying DeFi protocols, lending platforms, liquidity pools, other strategies. They're constantly searching for the best returns and automatically shifting your funds to optimize yield.
So it's like hiring a robot portfolio manager for my stablecoin yield.
Kinda, yeah. It automates that whole complex process, saves you tons of time, effort, and importantly, gas fees, because you're not making all those individual transactions yourself. The vault does it in batches much more efficiently.
Okay, sounds powerful. What's the catch? What are the risks with aggregators?
The action is simple. Deposit your stables into a vault on Yearn or Beefy. Confirm. Let it work. The catch is compounded protocol risk. This is really important. You're not just trusting the smart contracts of the underlying protocols the aggregator uses, like Gav or Uniswap. You are also trusting the smart contract code of the aggregator itself.
Ah, so it's an extra layer of smart contract risk.
Exactly. If there's a bug in the aggregator's own code, it could potentially impact funds across all the different strategies it's using. It adds another potential point of failure. Plus, you still have the underlying smart contract risks of the protocols it interacts with and the deheg risk of the stablecoins themselves. So aggregators are powerful, convenient, but they definitely increase your overall risk exposure due to that extra layer. Needs careful consideration.
Makes sense. Higher potential reward, higher complexity of risk. Okay, these strategies seem great. Are there more advanced things people do, especially using those cross-chain bridges we talked about?
Oh yeah. Once you're comfortable with the basics on one chain, being able to move stablecoins across networks opens up really sophisticated possibilities. Portfolio optimization. You can actively manage where your stablecoins are deployed across different L2 or even mainnet. Maybe Arbitrum has better lending rates for USDC this week, but Base has a great new LP opportunity for DAI next week. You can use bridges to shift capital to chase the best yields, access specific protocols only available on certain chains, or just spread your risk across multiple ecosystems. Arbitrage. For the really experienced folks, Fast bridges allow for cross-chain arbitrage. If USDC is trading at 0.999 on one L2 and 1.001 on another, a quick trader could use a bridge to buy low on one, sell high on the other, pocketing the difference, minus fees. Requires speed, capital, and know-how. Multi-chain DeFi strategies. This gets really complex. Building strategies that span multiple networks, maybe borrowing on Aave on Polygon, bridging the stables to Optimism to LP in a specific pool there, maybe using the LP tokens as collateral elsewhere. Where's deep market knowledge? Managing risks across chains, definitely advanced stuff.
Wow, okay. That's next level. With all this moving around, earning income, what about compliance, taxes? That sounds like it could get complicated fast, and it's definitely something people worry about.
It is complicated, and it's something you absolutely cannot ignore. Compliance and taxes are critical. First, be prepared for KYC. Know your customer. Some bridges, most centralized exchanges, might require ID verification, proof of address, maybe even source of funds checks, especially for larger amounts. Regulators are pushing for this. Second, tax implications. This is huge. Moving assets across chains might be a taxable event in some places. Earning interest from lending, taxable income. Earning fees from LP, taxable income. Profits from yield aggregators, taxable income. You must keep meticulous records. Track everything. Every transfer timestamps, amounts, source of destination addresses, protocols, cost basis. Know what you paid for your assets. Essential for calculating gains or losses when you eventually sell or swap. Income records. Keep track of every penny earned from interest, fees, rewards.
Sounds like a lot of bookkeeping.
It can be. For anything beyond very simple stuff, seriously consider using crypto tax software. Or, even better, consulting with a tax professional who actually understands cryptocurrency. Especially if you're doing complex multi-chain strategies. Tax authorities worldwide are getting much better at tracking crypto. Accurate record keeping isn't optional anymore. It's essential to stay compliant and avoid headaches down the road.
Okay, we've covered earning passive income, moving coins around, but none of it matters if your underlying stablecoins aren't safe, right? This brings us to the absolutely crucial topic of secure storage, especially if you want to engage confidently with DeFi. Let's talk hardware wallets.
Couldn't agree more. Secure storage is foundational, non-negotiable in crypto. We generally talk about wallets in two main categories, hot and cold. Hot wallets, mobile apps, desktop software, browser extensions, they're connected to the internet. Super convenient for quick, everyday transactions. But because they're online, they're inherently more vulnerable to hacks, malware, phishing, all that nasty stuff. Fine for pocket money, not for your life savings.
Okay, so hot wallets are convenient but riskier. Cold wallets are the opposite.
Exactly. Cold wallets, specifically hardware wallets, store your private keys offline. That's the fundamental difference and their biggest advantage. Your private keys are what prove you own your crypto. Keeping them isolated from the internet drastically reduces the risk of them being stolen by hackers. That's why hardware wallets are considered the gold standard for long-term storage, for holding significant amounts. They add that essential, robust layer of security everyone serious about crypto really needs.
Got it. So, regardless of whether someone uses a hot wallet for small amounts or a hardware wallet for larger sums, what are those universal security rules? The best practices everyone should just drill into their heads.
These are absolutely non-negotiable habits for everyone in crypto. 1. Strong unique passwords in 2FA. Use complex unique passwords for every crypto site, exchange, email. Don't reuse passwords. And enable two-factor authentication 2FA everywhere you can. Use an authenticator app like Authy Google Authenticator. It's much more secure than SMS-based 2FA. 2. Never share key seed phrase. Your private keys or your 1224-word recovery phrase, seed phrase, are your crypto. Anyone who gets them can steal everything. Never, ever share them. No legitimate company or support person will ever ask for them, period. 3. Secure offline seed phrase backup. That seed phrase is your only backup if your device is lost or broken. Write it down physically. Paper, metal plate, store it securely offline. Multiple locations if possible. Fireproof safe. Safety deposit box. Never store it digitally. No photos, no emails, no cloud drives. Hackers look for those. 4. Phishing vigilance. Scammers are clever. Be super suspicious of emails, text, DMs asking for info or urging you to click links. Always double-check website addresses, URLs, carefully. Is it really uniswap.org or is it unallswap.com?
If unsure, type the official URL directly into your browser. 5. Keep software updated. Update your hardware wallet's firmware. Update the apps you use with it, like Ledger Live or Tangent App. Updates often contain critical security patches. 6. Diversify storage. Maybe don't keep everything in one place. Hot wallet for daily spending money. Hardware wallet for your main stash. 7. Verify recipient addresses meticulously before you hit send. Check that address. Again, blockchain transactions are final. Send to the wrong address. Poof, gone forever. Do that small test transaction first.
Okay, great list. Vital safeguards. Now, let's get to the comparison a lot of listeners asked about. For connecting securely to DeFi lending on Aave, LPing on Uniswap, using Yearn, how do two popular hardware wallets, Ledger and Tangem, stack up? Which one has better support for that kind of active DeFi use?
Yeah, excellent question. Both are strong contenders, but they have different approaches, different philosophies. Let's break them down. First, Ledger. Think Ledger Nano X, for example, how it works. Classic hardware wallet. Stores your private keys offline on a secure chip inside the physical device. When you make a transaction, the details are sent to the Ledger device, you check them on its little screen, and you physically press buttons on the device to approve the signing. The keys never leave the device. Management and DeFi connection. You use the Ledger Live app on your computer or phone to manage your portfolio. And crucially for DeFi, Ledger devices connect really well to tons of dApps using Wallet Connect. That's the standard secure connection method, often using a QR code, that lets the DeFi site talk to your Ledger without exposing your keys. You approve everything on the Ledger itself. Recovery. If you lose your Ledger, your crypto isn't lost if you have your secret recovery phrase backed up safely. That 12 or 24-word phrase lets you restore access to your funds on a new Ledger or another compatible wallet.
Okay, so Ledger uses the traditional seed phrase for backup and Wallet Connect for DeFi. What about Tangem? It looks quite different, like credit cards.
Right. Tangem is unique. NFC cards. How it works. Tangem's big selling point is it eliminates the seed phrase. Instead, you typically get a set of 2 or 3 NFC cards. Your private keys are generated and stored securely offline on the chips inside these cards. To sign a transaction, you use their mobile app and just tap the card to the back of your NFC-enabled phone. Again, the keys never leave the card. Management and DeFi connection. You use the Tangem app on your phone. And importantly, Tangem wallets also connect to DeFi apps using Wallet Connect. Same standard, same secure connection method as Ledger, allowing you to interact with Aave, Uniswap, etc. Recovery. No seed phrase means recovery works differently. If you lose your primary card, you use one of your backup cards from the set you bought to regain access via the app. It relies on a secure link established between the cards when you first set them up.
Okay, so both use Wallet Connect, which is the standard way to link to DeFi apps securely. So when we talk about better support for DeFi, is there actually a difference between Ledger and Tangem in that regard?
That's the key insight here, the idea of better support for DeFi connectivity. It's not really about technical compatibility because both Ledger and Tangem use Wallet Connect, and Wallet Connect is widely supported by almost all major DeFi protocols. This means both offer robust, reliable support for interacting with services like Aave, Uniswap, Yearn, Beefy. Both allow you to safely sign transactions initiated by these dApps, keeping your keys offline.
Ah, okay. So the difference isn't in whether they can connect to DeFi, but maybe how they handle security and recovery.
Exactly. The choice between Ledger and Tangem for DeFi use really comes down to your personal preference regarding the recovery mechanism and the overall security model you're more comfortable with. Do you prefer the traditional seed phrase method, Ledger, where you have this physical backup phrase you need to protect? Or does Tangem's seedless approach, using backup cards, feel simpler or more secure to you? Both methods ensure your private keys stay offline when you're signing DeFi transactions, which is the most important thing for security. So neither has technically better DeFi support via Wallet Connect. They just offer different ways to achieve that secure connection and manage your backup. Both are excellent choices for securing stablecoins and using DeFi safely.
That's a really important clarification. It's about the user's preference for the security model, not a technical limitation in connecting to DeFi. So bottom line for our listeners, securely moving USDC from Coinbase to a hardware wallet using Base L2, then connecting that wallet to platforms like Yearn, Beefy, Beef, or Uniswap to earn passive income. Totally doable, totally secure with either a Ledger or a Tangem.
Absolutely. That whole flow-efficient L2s like Base, reliable hardware wallets like Ledger or Tangem, secure connection via Wallet Connect, it makes actively using your stablecoins in DeFi not just possible, but pretty efficient, secure, and accessible now. It's a really empowering setup for digital asset holders. Hashtag outro.
And that, I think, wraps up another really insightful deep dive. Today, we went deep into stablecoins, hopefully helping you unlock their potential. We looked at the big players, USDC, USDT, the role of DAI. We explored how crucial regulation is like the Genius Act in the US, MiCA in the EU for shaping their future, their longevity, their trustworthiness.
Then we mapped out those efficient, low-cost pathways using layer 2s and bridges, showing you how to move stablecoins quickly and affordably. And then the exciting part, putting them to work. earning passive income in DeFi through lending on Aave, providing liquidity on Uniswap, using yield aggregators like Yearn and Beefy, all while making sure your assets are locked down tight in secure hardware wallets like Ledger or Tangem, both offering great safe connectivity to DeFi.
Yeah, and we really hope this knowledge arms you, gives you the tools to navigate digital finance with more confidence, making informed choices that, respect your time, manage your risk effectively, and really expand your opportunities in this fast-changing world. It's all about empowering you.
Exactly. And as we sign off, maybe leave you with a provocative thought to mull over. We're seeing governments worldwide staking their claims in digital currency, the U.S. championing private stablecoins within regulations, the EU pushing its own CBDC, the digital euro, while also regulating stables. It really feels like a new kind of currency war is emerging.
Currency war.
So how will this global regulatory divergence ultimately shape the future of digital money? What does it mean for the U.S. dollar's international role down the line? And maybe most importantly, how will these big geopolitical shifts impact the choices, the opportunities, and maybe even the risks available to you, the individual, navigating this space? Lots to think about. Keep learning, keep asking questions, and above all, stay well informed.